Good morning, everybody. It is 10 a.m. on the dot, and it is Wednesday, November 19th, 2025. It's time for our weekly webinar. So good to see you. It's a cloudy, dreary day here in southeastern Pennsylvania, Yardley, Bucks County, to be more specific. I hope it's nice and warm and sunny where you are. Today, we're going to go through our normal schedule. We're going to have some information from the Slott Group. We're going to talk about the markets, and then we're going to have our financial focus. And today's financial focus is going to also be about some market activity, not necessarily what's happening in the market or what we think is going to happen in the market, but when you should make changes to your investment strategy. We've had some difficult times in the markets difficult time in the market over the past few days. It sparked a conversation when I was out with some friends on Saturday night. And so like many other times, I said to myself, boy, this would make a great webinar topic. So we're going to talk about that today probably at about the 30-minute mark. So one of the things I've learned since doing these YouTube videos is that many of you viewers are a little impatient. So we like to index where the topics are in the video. We have that. If you do like these videos and I'm not talking too much in the intro for you, you can subscribe, hit the like and notification buttons. But we do have a lot of great material, and we run for about an hour in these long videos. And because I share a lot of information, but we do index it so that you can jump to it. Hi, Emily. Good morning. Thank you for saying hello. It's funny how people say, just get to the point. And, there's all these crazy comments, but I do like chatting with you folks. And we started these videos as a way to keep in touch with clients during the pandemic. And we've just kind of moved and kept it going. And now 500 plus videos later, 5 years later, and 500 videos later, we're still here, and I'm chatting with you folks from all around the country. So hello, everybody. We're going to jump into the Slott Report to keep things going. So I'm going to share my screen with you here, and we're going to read along together. And our friend Andy Ives writes about the tricky still working exception. That's after and after death. So we have this still working exception to required minimum distributions. If you're less than a 5% owner of the company you're currently working at, you don't necessarily have to take distributions. But we're going to talk more about it in this, or Andy's going to talk more about it in this letter today. So for those of you who have 401ks or other retirement plans, Andy writes, the required beginning date, an RBD, when required minimum distributions, your RMDs, are officially turned on is April 1st of the year after the year a person turns age 73. This is the same RBD applicable to IRAs. However, if a person is still working, let me get my little cursor off of there. If a person is still working for the company that sponsors the 401k, and if that person does not own more than 5% of the company, then RMDs from the company retirement plan can be delayed until April 1st of the year after the year the person retires. So it kind of resets another RBD for your RMD, April 1st of the year after the year the person retires. This is commonly called the still working exception. Some additional details about the still working exception include the following. It only applies to RMDs from employer plans like a 401k or 403b plan. It does not apply to IRAs. So your own IRAs doesn't apply. If you're still working you've passed that required beginning date, you must take your required minimum distributions. It only applies to RMDs from employer plans like 401ks. As I said, does not apply to IRAs or IRA-based plans like simple IRAs or SEP IRAs. If it has IRA in the title, you've got to take those RMDs even if you're still working. It does not apply to employer plans if the person is not currently working for that company. A lot of confusion around this. People think, okay, well, check. I've got a 401k, check, it's a 4 or a 403b. I'm still working, therefore I don't have to take my required minimum distribution. But if you're not working in that company and you have a previous 401k and from another job, a previous job, and you've crossed over that age 73 and you've got that required beginning date, you must take that required minimum distribution by that required beginning date. Next, the still working exception is optional on the part of the plan. It is not a required design feature, although most plans do allow it. Remember that we have rules set forth by Congress, the IRS, the Department of Labor that have to do with 401k plans and retirement plans. But retirement plans can always be more restrictive. They can restrict on the age that you can take distributions if you're still working. And they can restrict on whether they have loans or allow for the still working exception, for example. So pay attention to that. An employee must work through the entire year for the still working exception to apply for that year. That's very, very important. That last bullet point about retirement separation from service trips people up the most. For example, if a 75-year-old employee retires in late December, then an RMD will apply for that same year. That RMD can be delayed until April 1st of the next year unless a rollover is done prior to the RBD. Now, this is another common issue. Someone will say, well, I'm retiring December 31st. I'm going to roll over this 401k January 1st. And hopefully the custodian of the rollover is or of the 401k plan is going to do the RMD before they send it, but it is your responsibility. I had a question in class last week. We're holding a class right now at Mercer County Community College outside of Princeton, New Jersey, and a person said, well, isn't it the firm's responsibility to tell you or to distribute these funds for you, the required minimum distribution? And the answer is no, it's your responsibility. It falls on you. We do everything that we can for our clients to make sure that required minimum distribution is distributed. And Jessica from our office keeps track very, very, she's been doing this for, almost a couple of decades. So she's got a method of keeping track of these required minimum distributions, but ultimately it's on you. So don't count on the Vanguard, Fidelities, the Schwabs of the world to do it for you. These are your responsibility. This is your responsibility. Now, I know it can be confusing and the rules are confusing but so work with a qualified individual who can help you with it, but the responsibility is yours. All right. So where the heck were we? Let's go here. The RMD, here we go. That RMD can be delayed until April 1st of the next year unless a rollover is done prior to the RBD. Okay, that's what got me off on that little soapbox. Or if this hypothetical 75-year-old was laid off, that would also result in an RMD for that year. To ensure that an RMD is avoided for a particular year using the still working exception, the safest bet is to schedule your official retirement/separation from service date for January 1st or later of the following year. And to avoid IRS scrutiny, you should actually work up to and including that January retirement date. Speaking of time and separation from service, there is a tricky scenario with the still working exception that must be considered. And here's an example. So let's slide this up so you can see the whole example. Roger is age 75 and still gainfully employed at ABC Incorporated. He participates in the company's 401k and has been delaying RMDs from the plan for a few years. Roger anticipates working until he's 80. Holy cow, Roger. Sadly, Roger had a heart attack and died. Of course, this ends Roger's career at ABC Incorporated, and he is no longer an employee. Since Roger has separated from service, albeit not in the fashion he intended, and since he is no longer still working, does this mean he has an RMD from the ABC Incorporated 401k in his year of death? He does not. Remember, the RBD, required beginning date, when RMDs, required minimum distribution, are officially turned on is April 1st of the year after the person turns age 73 or April 1st of the year after the year a person retires if using the still working exception. Now remember, because someone's going to say it, that does not apply to IRAs and it does not apply to previous 401ks from previous employers or previous 403b plans from previous employers or simple IRAs or SEP IRAs. So moving on here, we're here. You must live long enough to reach that date for RMDs to officially begin. Since Roger died before his required beginning date applicable to his 401k plan, there is no year of death RMD from the plan for his beneficiaries to worry about. Interesting. So complex. I know it's complex. Again, that is why I don't know how people do this on their own and they stay abreast of these things. And honestly, very, very few do efficiently because we see the aftermath. Often people come to us with a whole mess of problems from time to time. Okay, now here's the Slott mailbag. So these are questions that come into the Slott group. The 5-year clock and qualified charitable distributions. Today's Slott Report mailbag. I really enjoyed this second one here. So this is again from our friend Andy Ives. So the question is, a husband owned a Roth IRA which has been in existence for at least 5 years. He died in January of 2025. His wife was his primary beneficiary. So husband passes away, Roth IRA. He's had the Roth IRA for at least 5 years. Wife is his primary beneficiary. The wife opened a Roth IRA in late January 2025 to receive the distribution from the husband's Roth IRA. Makes sense so far. The wife then unexpectedly died at the end of February 2025, same year. And each of the 3 adult children receives 1/3 of her Roth IRA into inherited Roth IRAs for each of them. So all done properly. Are the kids' inherited Roth IRAs subject to the remainder of the 5-year rule because they inherited assets from their mom's Roth IRA, which had only been in existence for less than 1 month? Or are they exempt from the 5-year rule because the dollars could be sourced back to the dad's Roth IRA, which had been in existence for at least 5 years? He wrote, thanks in advance for your input. Here's the question. We have 2 sets of beneficiaries. First, the wife. So wife inherits the Roth IRA. The husband's Roth had been in existence more than 5 years. No problem. The 5 years carries over with the transfer to the beneficiary. So if the IRA owner had not satisfied that 5-year rule, the remainder, it doesn't reset. The remainder, and it's also not forgiven. So the remainder tracks over. So the remainder tracks over to the beneficiary. If the beneficiary has, if the Roth IRA is 4 years old and the beneficiary has 1 more year before all distributions are tax-free, before they're all qualified, as they're called, qualified distributions. So now the next step is, unfortunately, the mom passed away very soon after that. So the question is, well, now whose 5-year rule? Is it the mom's 5-year rule or the dad's 5-year rule for the subsequent beneficiaries? So now the kids inherit it. So this is a good question. And this is where, again, things get complicated. So the answer is Jeff, this person who wrote in is Jeff. When the husband died, his 5-year clock carried over to the wife with the spousal rollover. I assume she did not have her own Roth IRA. Hypothetically, if she did, then the wife could choose the 5-year clock that was most beneficial to her. Doesn't really matter. It seemed the husband's was already passed. So if whichever worked fine, whichever worked best would be fine. Now that wife has died, the children all get the 10-year payout rule on the inherited IRA. So you all know that you have to completely distribute the assets by the 10th year following the year that you passed away. If you didn't know that before, you know it now. And there are no required minimum distributions in year 1 through 9 with Roth IRAs. There can be with traditional IRAs, but we're talking about Roth IRAs. So there is one big required minimum distribution, and that is the 10th year, the year following the year you passed away. So Andy goes on to write, there are no annual required minimum distributions, RMDs, in years 1 through 9. After their dad's original 5-year clock is satisfied, then all earnings in the inherited Roth IRAs will be tax-free. For now, they will have tax-free access to any contributions or conversions that dad did. Based on the Roth IRA ordering rules, contributions come out first, then converted dollars, and then the earnings. So it carries over. It carries over to the subsequent beneficiaries is the short answer to that question. This next question. My client is age 72. He has a traditional IRA and an inherited IRA. She would like to make, switch genders there. So my client is age 72. She has a traditional IRA and an inherited IRA. She would like to make a 2025 qualified charitable distribution, or QCD, from the inherited IRA for $1,000. So the money's coming from the inherited IRA, which is allowable. That distribution is going to go direct to the charity, paid paid direct to the charity with the required paperwork received and kept. And that's a good qualified charitable distribution, or QCD, from an inherited IRA. That's allowed. Because she is making a QCD from the inherited IRA, is she allowed now to make a 2025 deductible contribution to her traditional IRA? So she has two IRAs. She has got her own IRA, and she has an inherited IRA. She's saying, I'm going to take a distribution from the qualified charitable distribution of $1,000, send it directly to a charity from my inherited IRA, but surely that doesn't affect my traditional IRA. Well, let's look at the answer. After age 70 and a half, deductible IRA contributions and QCDs do not mix. If a deductible contribution is made to an IRA at age 70 and a half or older, that amount will offset the same amount of any future QCD, thereby making all or a portion of the QCD a taxable distribution. It does not matter that she is doing the QCD from the inherited IRA. If she makes a deductible IRA contribution of $1,000 or more, her entire $1,000 QCD will be taxable. So she, without having this specific knowledge and without asking this question, so it's a good question from this person that has the inherited IRA and the traditional IRA would have realized the taxable event that which he wasn't planning on, because a qualified charitable distribution, you send it right to the charity, you don't pay tax on that distribution unless you make a mistake like contributing to a traditional IRA if you're over age 70 and a half, and you can't do a QCD under age 70 and a half anyway. So that's where the issue lies. So great question, really nuanced question, but I bet it comes up more than people think. All right, so moving on, let's talk about the markets. Holy cow, last week. Last week actually wasn't bad. The last few days, however, I guess we started to see a turn at the end of last week, but the last few days have been pretty tight. All right, so let's see here. So our analyst writes, the U.S., and this is as of November 14th, 2025, so last Friday, close of business last Friday. The U.S. equity markets finished the week mixed as the S&P 500 and the Dow posted modest gains, while the NASDAQ composite ended marginally lower, driven by weakness in large tech names. Rising anxiety continued, and stock markets saw sharp declines early this week. So as we're looking at it now, I don't have a screen up, but last time I looked at the screen prior to this webinar, the markets are up a bit, I think a little mixed. Markets started last week on a positive note as investors welcomed signs that the government shutdown was coming to an end. As the week went on, that optimism faded due to investor concerns over valuations in the tech/AI sector, and comments from the Federal Reserve signaling that inflation remains a concern and further rate cuts are not certain. So that was really the big thing. The Fed signaling, well, wait a minute, everybody's building in these rate cuts for the rest of the year, and we might not be seeing that. We saw signs of sector and style rotation in the stock markets as technology and growth stocks cooled a bit, while more defensive and value-oriented sectors like healthcare, materials, and energy picked up a bit, got more attention. With the longest government shutdown on record ending, economic data has been delayed or missing. We can expect to see a backlog of data releases such as labor markets, consumer price index, producer price index, personal consumption, etc. Investors are anxiously awaiting more clarity on the economy. So these delays are affecting how individual investors, but most importantly, the institutional investors are feeling about things. The government reopening has reduced the draft. Oh, I just talked about that. This talks about furloughs coming back to fundamentals again, and with growth and inflation remaining the central focus. So again, that's really what I think is driving this setback. Treasury yields moved higher, with 10-year treasuries ending the week at 4.15%, a sign that investors were pricing in less chance of a rate cut in December. Back to that rate cut. Gold prices went up about 2% for the week, and that shows us investor demand for that safe haven. Okay, I'm worried about the stock market. I'm going to go to gold. What do we have the week ahead? Monday, we saw construction spending that showed modest growth. and there's some non-residential weakness. Yesterday, we had the delayed jobless claims released for the week ending October 18th. That came up modestly, showing initial claims rose to $232,000 for the week, but remained below the 4-week average of $237,000. Today, we're seeing new residential construction, release of minutes from the FOMC meeting, and of course, NVIDIA is reporting earnings. Everybody's kind of waiting to see that. This is not a recommendation to buy, sell, or hold NVIDIA. It is just probably the most important stock on the stock market right now. So everybody's paying attention to it. And on Friday, we see the Philadelphia Federal Reserve Manufacturing Survey and existing home sales. We always like to look at opposing views from different large investment firms and large analysts. So we look at the bullish side, the optimistic side. Morgan Stanley is expecting the S&P 500 to rise about 16% by the end of 2026 to 7,800, driving what they call a rolling recovery and a structural shift towards higher inflation regime that the Fed may tolerate. So I heard that in a story today as I was preparing for the day and this webinar. A person, I don't remember the person's name, but the person was saying, I don't care about as much about inflation as I do economic growth. So they want to see economic growth. They want to see the growth to our debt. The GDP ratio is much more important to them than inflation. So that was an interesting take on that, and we'll see. So we're talking about, again, Morgan Stanley talking about a structural shift towards higher inflation regime that the Fed may tolerate. So they might tolerate this higher inflation if we're seeing the economic growth to sustain it. Invesco states the backdrop for risk assets remains favorable. So when you hear risk assets, think about the overall stock market. You hear these terms, risk on, risk off. Risk on simply means people are putting more money into the stock market. Risk off means people are taking more money out of the stock market and putting it into things like gold and treasuries and short-term treasuries and money markets, things like that. So they're just fancy terms for those things. Yields are low. Oil prices and inflation expectations remain contained. Our global leading economic indicator points higher, and a U.S. monetary policy easing cycle has commenced, Invesco says. They further state, we remain mindful of valuations, but don't believe this is a bubble. Instead, we see an opportunity for investors to position portfolios toward better valuation profiles and cyclical exposures. So that's from Invesco. So they're optimistic. Morgan Stanley certainly is optimistic. Now, on the other side of that, on a more bearish approach or less optimistic, BlackRock Investment Institute continues to emphasize structural themes such as AI and other mega forces reshaping growth, but cautions that valuations and policy uncertainty remains meaningful risk. So they're saying, watch out because we could be really frothy and we've got policy concerns. Bridgewater's co-CIO, Chief Investment Officers, warned investors may be underestimating major risks in the current AI-driven rally. They argue that growth expectations embedded in equity prices, stock prices, are extremely optimistic, perhaps among the most bullish in nearly a century. So they're saying it's for more than 100 years we haven't seen this kind of over-optimism in a particular sector. So that'll be interesting. So we've got large organizations, well-respected organizations that can agree where the market's going to end or where it's going to go in the next year or so. So how do you manage that? We're going to talk more about that during our financial focus that we're going to go to in a second. But really, the answer is let your financial plan drive your investment strategies. Get some clarity on that. Get your clarity on what funds you're going to need and when. And when you know what funds you're going to need and when, then it becomes much simpler. I don't want to say it's easy, but it's much simpler to make these decisions around, how should I be invested? because when you have those fundamentals, I call them the 3 pillars of investment management. We have asset allocation. Of course, we need strong asset allocation, efficient portfolios, all those things. Asset allocation, principal protection, and account segmentation. And I'm starting to call it account segmentation retirement income plan, just because that kind of brings it all together. But so asset allocation, principal protection, account segmentation, retirement income plan. I'd like all the team to start writing that down. Account segmentation, retirement income plan. So when you have all those things working together and you're updating on a regular basis, you should be doing your financial planning process every single year and updating, staying very much on top of your investment strategies and the individual components of them. We have 2 investment committee meetings a week. So we certainly stay on top of the components of the investments, but the planning needs to happen at least once every year, and certainly when there's major life events, new employment, losing employment, leaving employment, significant changes in your life, things that would just say we need to take a look at everything and make sure that the track that we're on is still the right track for us. But when you have all that together, you've got that foundation and you can make good investment decisions. Because if you just go by what's happening on the TV screen today or the computer monitor in front of you, you live in a whole lot of world of uncertainty, and that is never a good feeling, and it makes it difficult to make these decisions because now you're driven on emotion. We can't separate emotion from our money. We can't do it. But we can certainly allow processes to let us make better decisions. Because when the big experts can't agree, that should give us some sense of well-being, because, well, geez, if these very learned individuals with all the resources all around the world can't agree on where the market's going, how the heck am I supposed to know as an individual investor? So rely on your training and experience, right? Like we did in law enforcement. You've built your foundation: asset allocation, principal protection, account segmentation, income retirement plan. And that's what it is. It's account segmentation, income retirement plan. Write that one down. Account segmentation, income retirement plan. But when you have that strong foundation, then it helps you make decisions along the way. And you can withstand these big market shocks. So I'm going to come back to announcements at the end of this, and I'm going to go into our financial focus. Okay, so this is the financial focus portion of today's webinar. We just left the weekly webinar, and in this section, this last half hour, this financial focuses, we're going to talk today about when to make changes in your to your retirement investments. So almost like all of these webinars, this came from a triggering event out there in the world, whether it's something I learned at a workshop or I talked to a client about. But this came from a discussion I had Saturday night when I was out to dinner, a late dinner with some friends. And it was interesting because these 2 women are in very different places in their life. One is in their mid-30s and one is in her 60s. And the one in her mid-30s said, she's in a good position and she's got some funds saved, and she said, I just don't know what to do. I kind of hear this craziness that's going on in the world. The market has been is very uncertain, and I feel like I should just pull everything out and maybe go to cash for a while. And I said, what do you need? What are you saving your money for? And she said, retirement. Now you may think, well, she's in her mid-30s. She's got a long time to retirement. And so I asked her, I said, I didn't turn it into a financial planning discussion. We're just having appetizers and a cocktail. But I said, well, when do you plan on retiring? And maybe in her 50s, but probably traditional age 60 or so. Well, you might be saying, you folks that are more experienced might be saying, well, geez, Louise, she's got a long time to worry about this, so she should probably be in a pretty growth oriented strategy, and I talked to her about that a bit, and the other person, the person in her 60s, talked to her about it as well, and these are from places of both experience and confidence, right? And I'm going to talk about that experience and confidence in a second, but that was the driver of today's topic. I'm going to share my whiteboard with you so we can go through some things together. So I shared with you why this topic. And when I think about when you should make changes to your investment strategies, it should be very purposeful, not due to noise that's coming from the TV, the internet, your cell phone, or what's going on in the world. I'm not saying you should be blind to what's going on in the world, but it shouldn't be the major factor to drive your investment decisions. Your investment decisions should come from your financial plan. Your financial plan should be a true, real, comprehensive plan. I'm fortunate enough where I coach financial advisors around the country. And unfortunately, what I see with some of those folks and what I see from clients coming in is that most financial plans are razor thin. They don't go very deep. They don't really identify someone's needs, goals, and issues and take the time to work through really what's needed and when. So, but if you have a true financial plan or real financial plan, then and a comprehensive financial plan, then you can. And just because someone says it's a comprehensive financial plan doesn't mean that it is. But I guess we should do. I'll do a topic about that. I've done one before, but I'll do a separate topic about that. But moving on, because I know sometimes the viewers are impatient to get to the point. But when we're talking about when you should make changes to your investment strategy, it really has to do, I think of it as what's a market cycle? What's a typical market cycle? And how far are we away from needing those funds? So what do I mean by market cycle? Let's first talk about what do I mean by market cycle? What is a market cycle? So let's go to the definitions. So for you, now this was interesting. This is the first time I did this today. You'll see that my resources for two of these snippets here are Google's Gemini. And what's interesting is I like to use things like Investopedia and some well-known firms like Vanguard, Fidelity, JP Morgan, BlackRock for some of this material. But I've been finding that these AI searches, although you have to be very, very careful, these for accuracy, but these AI searches are really packaging things up nicely. But let me read along with me here. A stock market cycle is the natural patterns of ups and downs in the financial markets, consisting of 4 phases: accumulation, markup, distribution, and markdown. We're going to go over that in a bit. These cycles are driven by economic conditions and investor sentiment, moving between bull markets, that's rising prices, and bear markets or falling prices. 4 phases and then it goes into 4 phases of the stock market cycle. The first is accumulation. Accumulation, this is the bottom of the cycle where a market has bottomed out and prices begin to rise after a downturn. Investor sentiment is often pessimistic. They don't think this is going to be good going forward. Everybody's sitting in, or the majority of people are sitting in gold or cash or whatever, but they're pessimistic. But smart money starts buying at low prices. Now, let me pause here and say, I didn't say it at the top of this section here, but this is the information I'm giving you today is for education, not advice. Advice is very, very specific and individualized. If you'd like to reach out to us and schedule time with me, and if you have at least $1 million in invested assets, you can do so. You can reach out to us at attleboroughwealth.com. I'll just put my website up here, our website up here, attleboroughwealth.com. Or you can email us at questions@attleboroughwealth.com. If you go to attleboroughwealth.com, there's a section in there under Contact Us where you can schedule, if you're not a client, you can schedule a 15-minute discovery call. If you have at least $1 million in invested assets, I welcome you to do that if you have questions. But that's for specific advice, and I'm happy to go over some things with you. And even I can't even offer specific advice unless I have an agreement, unless someone's a client. So please take this as education and take all the education you can get. All right, so that's accumulation. Prices, the bottom of the cycle where a market has bottomed out and prices begin to rise after a downturn. Investor sentiment is often pessimistic, and smart money starts buying at low prices. Then we have markup. The markup, as more investors enter the market and sentiment improves, stock prices begin a sustained rise. This phase is characterized by increasing volumes and bullish sentiment. More people think that the market's going to rise. That's a bullish sentiment, sometimes leading to euphoria, right? Oh, this market's going to just continue. It's never going to stop. We've seen that. I've heard that from people over and over again. Oh, the market's screaming. It's going to continue to go up. And then sometimes there's a significant setback. So that's markup. Distribution. In this phase, smart traders begin selling their holdings as prices reach a peak. The market sentiment shifts from bullish to mixed or neutral, and prices may remain relatively stable for a time before a downturn begins. So you've got to be a smart, they're saying you got to be a smart person at every step of here. It's very, very hard to time the market. So it's nearly impossible, in my opinion. We're going to talk about that a little bit and how you handle these things. But what I'm going over today is just the market cycles. And then we have markdown, or what I'm going over in this section is just the market cycles. Then you have markdown. Let's go back here. This is the downtrend phase where prices fall significantly as investor sentiment turns negative and a bear market sets in. This phase is characterized by fear and selling pressure, often leading to significant losses for those still holding positions. And here's some key takeaways. So key takeaways right here. These are right here. Market cycles are closely tied to large-scale economic business cycles. Identifying the specific phase of a market cycle can be challenging in real time. And economic and fiscal policies can significantly influence the duration and intensity of market cycles. So and they're telling you got to be a smart person, right? Smart investor, but they're also telling you that it's really difficult to identify. And here's what we just saw, right? So here's your accumulation phase. This is from Investopedia. Your accumulation phase, your markup phase. These are when things are starting to go. So this is where they say, okay, here's smart people, right? Smart people. The smartest people are actually right here, right? They're buying in here. And then we have the distribution phase. And now this is, again, it's for only smart people. Smart people start selling here. Well, if you know when to buy here and when to sell here, well, you're the smartest person in any room. But then they tell you that it's really, really difficult to tell what phase we're in. So again, we're going to talk about how to overcome that, because you don't want to be in the markdown phase and then selling here. Now what most people do when they rely just on their emotions and they talk to their neighbor, uncle, aunt, brother, sister, friend about investing, most people unfortunately buy right around here and sell right around here, right? And that's the opposite of what you want to do. So it's not even that you're not smart people. It's just that you're driven by emotion and not driven by fundamentals, and you're not driven by the plan, right? Because being driven by your financial plan eliminates all this need of having to be a smart person, the smartest person that maybe I've ever met, and working within these market cycles. So that's what a market cycle looks like. All right, now how long is a typical, and this is, now I included this chart because this, it's not all bad here, right? It just doesn't end here and go on here forever. There's typically a pickup. So if you just compare these two, right, we've got this, when we see this accumulation phase, that's after a drop in the market. When here's the bull market rally, what they're referring to up here is markup, same thing, right? Then we have the peak, and this starts the distribution phase. And then we have the bear market fall, but then it picks up again. And that's a normal cycle of the market. So now how long do these cycles usually last? So cycle duration by phase. Bull markets have historically lasted much longer than bear markets. That's good news. Usually the markets are up more than they're down. For example, the average duration has been about 3.8 to 5 years, with varying returns. Now bull markets are when markets are increasing, right? We're going here, we're up. Bear markets are when markets are going down. Bear markets have historically been shorter, averaging about 1.3 to 1.5 years in duration. But just like good things tend to go by quickly, bad things tend to feel like they drag on. The bear markets hit us hardest from a feelings point of view, from an emotional point of view. They can also be devastating from a withdrawal point of view for a distribution from your portfolio, and we'll talk a bit about that. The full cycles, the total length of a cycle from peak to the next peak is often in the 4 to 10 year range. So what we often see is somewhere between, on average, 3 to 7 years when we're looking at this bit of it. So if we look at that 3 to 7 years, that's kind of the time, and some people say 3 to 5 years, but that's kind of the time from when we get back to that original question: when should you start making changes to your investment portfolio? So let's look back and make sure we're hitting all of our points here. So we talked about what is a market cycle. We talked about how long is that market cycle. So that market cycle is here we are. Looks like something like that. That was a terrible look at that. Let's do it again. See if I can make it better. It's a little bit better, but that's what a typical market cycle looks like. How long is it? Well, it's 3 to 7 years, or 3 to 5 years historically. Now, I want to look at this. So we're going to look at the S&P 500. Historically, we're going to look at the S&P 500. So that's growth. We're going to look at a S&P 500 percentage of high. We're going to talk about sequence of returns, risk. Then we're going to talk about advisor confidence, financial plan driven invested decisions, account segmentation, retirement income plan, and when to start adjusting. So let's look at. I'm going to pull this down. So I'm going to share our charting and our research software or platform with you. So we use this company Y charts. So here we are. We have the S&P 500. So you'll see here that this is the S&P 500 total returns. Now I just look at the last 10 years. Let me make this a little larger. So we're looking at the S&P 500 total return, if you can see that. And you can see the different dates. So this is a 10-year. And as I scroll through this, I'm going to take myself off the screen so you can see more. As I scroll through this, you can't see that, but it says 2016, and it goes all the way because we're almost at the end of 2025. So anybody would say, well, Jesus, this is a good run. But you can see these different market cycles that are kind of built into here. And, from peak to trough or peak to recovery, we've got pretty consistent times. Now, if we go back to 2020, for example, that's here. So this is the pandemic, and let me come in a little tighter. So here's 2020. So here's right the pandemic right here. So that was the start of the pandemic, and that was the bottom of the trough, as we call it, the drop. So short period of time. If we're looking at dates, you can see the dates in the top right. See where it says February 18th, 2020, and then it comes down here, and the bottom there was almost there. So March 24th, 2020, and then we started climbing back up, and we were actually ahead previous highs within the same year by September 1st, 2020. Now you have to remember that was unusual. There's a lot of government intervention that forced a lot of money out into the system. But if we look back here, so in 2018, we ended the year very badly in 2018. We were down significantly. So September, we had a high in 2018, and by the end of the year, we were down. And then it took, just about 5 months to recover. Let's see, just about 5 months, 4 months, 5 months to recover. So that was a short period of time. If we go back a little further and we go to the max, now this is going to get long because this is the S&P 500. This goes all the way back, to the start. But if we go to let's go find a Great Recession. This is going to look like a blip here. So let's find, I think we're right about here. Yep. So here we go. We've got 2008. It was actually started right at the end of 2017, but we've got 2018, 2019 represented right here. Now that looks like a tiny little blip, but I'm here to tell you that it felt like forever. And these are market cycles, and you can see that we do have periods of recovery. This was a big one. So this is 2022. 2022 was a terrible year. You remember that the stock markets and the bond markets fell significantly, and this is a pretty deep trough here. And it wasn't until December 6, 2023 here, or January 2024, when we really got back to full recovery. Now, again, this is just the S&P 500. I'm using this as a proxy to show you the broad markets. This is not a recommendation to buy, sell, or hold the S&P 500. Now, let me come back at a full screen, and I want to show you this because I like this, and we're going to go tight in to 10 years. These are the percentages off the highs. So this line here that you see, that straight line right where my cursor is, that's the high. And then we see the drop down. So 2016, you'll see the percentage drop. So that dropped negative 9.22%. Obviously, during the pandemic, we saw the drop all the way down to about 30. It was about 32%. Let's go down here and see if I can get a little closer there. There you go. 33.79%. 2022, again, we had drawdown all the way down to right here. We're about 24%. But these are short periods of time, right? Relatively short periods of time. If we go back to the Great Recession, 2008, 2009. Oh, I think I misstated that earlier. Let's go to 2008, 2009. You know, here's the Great Recession here. October 2007. I think I was showing you 17 before. Sorry. All the way to recovery in February. Let's see. The S&P 500 didn't fully recover. Geez, that carries. Look at that. 2007. The drop was to the bottom was 2009. We didn't actually see back to the high again until 2012 there. So that's always our stress test, is the Great Recession. So that is, when you're thinking about market cycle, think about that 3 to 5 year period and that drawdown, that drop from high to low. Here's 2000, September 1st, 2000, and you see that drop all the way down. There's your low, negative 44%. Didn't fully recover until 2006, right? The S&P 500. We're climbing back out of that hole there. So I think that's really interesting. So now when you say, all right, let me get rid of these charts. I hope that was helpful. Now when you look at, okay, so we talked about these two things. We've got to be concerned. The reason that people want to shift their money from risk funds, right, like the S&P 500 or stock, into more conservative investments or protected investments, is because they're worried about their money isn't going to be there when they need it. And this is that sequence of returns risk. Your investments being down when you need the money. Now, this is a real concern, because if I went back to that chart and I showed you, okay, well, this is when you retire, and then we hit, pick a year, whether it's 2000, the dot-com bubble, or whether it's the Great Recession, or whether it was the pandemic, or whether it was high inflation that we saw in 2022 driving everything, so and the economic factors that were a result of the pandemic. If you retired at one of those times and you had to start taking money out of your portfolio and the market was down here, that's difficult to recover from, because as you're drawing funds, as you're taking distributions out of your holdings, as the market's down here, it never gets a chance to recover. That's sequence of returns risk, when you're going to get those returns. And we can't time that. We can time when you're going to need the funds, but we can't time when you're going to get the returns. So that's why we go to, and I'll come back to advisor confidence, but that's when we come back to the financial plan driven investment choices. Because when you have a true, detailed, comprehensive plan that shows when you're going to need these funds, and you clearly identify the funds, that you don't just tell your financial advisor, hey, I'm going to need $5,000 a month during retirement, and it's really $8,000 a month, and you've never done the work to determine the true amount, then you don't have any method to make those investment decisions. Because the first thing that you have to do, I pre-filled this for you, is that you've got to kind of lay out your needs on your timeline. Now, we're using retirement here, and I'm going to come back to my younger person I was talking to in her 30s in a second, because she's far away from retirement. But you can't just assume. Let's just say that she's talking about her investment portfolio, and her investment portfolio could be $5 million. It could be $10,000. I don't know. We didn't get into that. But we were talking about retirement. Now, she could be thinking, I want to buy a new car, or I'm looking to buy a house. So her timeline could be very, very different depending on when she's going to need the money. Most of you are listening to this, either you're currently in retirement or you're planning retirement. And if you're in retirement, you're thinking, or we've done the work of your clients, okay, well, here I am in retirement. Now we have to map out what we're going to need over our lifetime, because you want your funds to last until you're no longer here. And whatever's left for most people, unless you have a specific estate goal and a legacy goal, it's whatever's left we want to pass to our heirs as efficiently as possible. So you've seen this before. This is the account segmentation strategy, where we develop individual portfolios based on risk and based on need of when you're going to need those funds. But first, you need to answer this question. This question is, how much money am I going to need in each one of these segments? Remember, the account segmentation income retirement plan. We're gonna hammer that down one of these times. So account segmentation income retirement plan. How much money am I going to need in each one of these segments? This comes from this question is answered by your financial plan. And only when you answer this question can you develop your investment strategy, lay out these investments based on needs and risk, because this is going to start as a 100% conservative portfolio. Let's say currently it's money market and short-term treasuries. And this last portfolio here could be 100% stock portfolio, because you don't need those funds for, in this example, 18 plus years. And then we ramp this up along the way. We go from 100% stock to 40% stock, 60% bonds, 60% bonds to 40% bonds. And we continue down there, 70-30, 80-20, 80-20, etc. And then it all conveyor belts down as you need those funds. So that's a tremendous amount of work. I get it. And you know how that works in a retirement strategy. But the question for today is, when do you start adjusting? Well, if you're in retirement and you don't have a plan like this, it's now, right? You've got to lay out your plan, start making adjustments. But I always say, if we're 5 years from retirement, within that 3 to 7 year market cycle, going back to the market cycle, or 3 to 5 year market cycle, you want to start making those adjustments now. You want to start having that plan. You definitely want to start at least filling this first segment, this 0 to 3 year segment. Because if you've got $2 million, for example, save for retirement, $2 million, save for retirement, you don't want to make massive changes based on what your fears and concerns are. You want to make calculated changes based on what your needs are. So if you're plus 5 years to retirement, maybe you can have a more general approach, a more growth-oriented approach with some protections. But if you're within 5 years of retirement, you want to start making your investment changes based on something like this account segmentation income retirement plan. And again, not just a 60-40 or 40-60 portfolio. You want individual portfolios based on when you're going to need those funds, and risk adjusted portfolios based on when you're going to need those funds. But you want to start making those changes 5 years out from that retirement date or from that need date. So now this 37-year-old person, or I think she's younger than 37, just in case she's listening, early 30s, mid 30s. She looks like she's 20. If you're 5 years out, for example, of retirement, certainly make the changes. But again, what if she needs to buy a house within 5 years? Do you think she should start making some adjustments? Yes. What if she just wants to buy a car in the next year? And she's got a lot of money in NVIDIA, and she's made a lot of growth. She's had a lot of growth, or maybe she bought it at the wrong time. She's not had so much growth, but should she start making some changes? Yes. So the answer to the question is, when should I start making investment changes? It depends on when you're going to need the funds. But you got to plan accordingly. You can't throw darts. You can't just guess. We don't want to make emotional changes changes based on emotion, because it typically doesn't work out well. So draft your financial plan, have a comprehensive financial plan, develop your investment strategy based on that plan, review it every single year or when you have significant changes in your life, and you should come out just fine. All right, let me talk about this advisor confidence, because this was really interesting. So we've covered everything else. I keep toggling between retirement income plan and income retirement plan. Sorry, we'll get that hammered down. But back to this advisor confidence. What I thought was interesting was this. Both of these ladies I was talking to have financial planners. And the younger one doesn't feel confident in her planner. She's using this financial advisor because it's the financial advisor her family uses. She doesn't really get much attention from them. She doesn't have a financial plan, that she can count on. That's in-depth, comprehensive, a real financial plan. That plan doesn't drive the investment decisions. She's got a lot of uncertainty. So she had a lot of questions. Just maybe I should just pull it and go into. I feel like I should put it in a CD or something. Is what she said. And now on the other side of that, and you know how I'm thinking already. I know the answer for her, right? I know how to get her answer, I should say. But the other person, on the other hand, so she's in her 60s, and she said, my guy said this, you're not going to be retiring soon. You're not going to, you're still working. You're still healthy. There's no need to make any changes because of this. Now, she has confidence in her advisor. Now, we didn't get into the details of what kind of financial plan she has. Maybe she's got a fantastic advisor who does all the things that should be done: tax planning, full comprehensive financial planning, and proper investment strategy. But whatever it is, she has confidence in this person. So she's staying in the right place for her because of this confidence. The other person has no confidence. I could see it just in her body language. She could make mistakes or bad choices because of this lack of confidence. You want a relationship that's going to bring you that confidence. You want a relationship, I think, that has that comprehensive financial planning strategy, has an investment process based on that planning strategy, does tax planning, pays attention to all the things that you should be paying attention to in your whole financial life, whether you're 35 years old and you're looking way forward to retirement, or whether you're 65 years old and you're retiring this year. Or maybe you're 75 years old and you're looking back and there's some things that you want to correct. I don't know, but you've got to have a relationship where you have confidence. We talk about this a lot. I want you to have confidence that in your retirement plan, to have the comfort. It's kind of the 2 C's or three C's. So the comfort, a comfortable retirement, and the comfortable financial life. Let's just say, if you're not in retirement, that you want and deserve. You want to have confidence that you can reach your goals and needs and objectives and overcome the issues that might come up. And you want clarity. You need that clarity. That's the 3rd C. If you're listening, Valerie. So that's you need that clarity to be able to see where things are coming from, where you're moving to, and how it's going to potentially play out for you. And you've got to do that. You've got to update these things on an ongoing basis. So every single year at a minimum, and significant life changes or significant changes in the economy, policies, things like that. I hope this was helpful today. I hope that makes sense. We went over a lot. We got it in just under the hour. So today was when to make changes in your retirement investments. We talked about market cycles, how long a market cycle is. We looked at the different cycles going all the way back to 1990 in the S&P 500. We looked at percentages off highs. We looked at different again, cycles within that one issue. We talked about sequence of returns risk. We talked about financial plan driven investment decisions, account segmentation, when to start adjusting, and advisor confidence. And all that is extremely important. Hang on if you want to for announcements. So we brought announcements to the end of this webinar, and we've got some things coming up. So we're just ending tomorrow night our last class for the year at Mercer County Community College. It was a 2-class series. Tomorrow night is going to be the second night of that 2-class series. No jumping in now. If you missed the first class, you can't attend the second one. We've got some, we're sponsoring some movies again this year. I think this is the 3rd or 4th year we've done this for the Newtown Theater, the holiday movie events. For clients, we have 10 complimentary tickets to each showing. And I'll share with you what those are. So they are showing The Bells of St. Mary's, I'll admit to you, I haven't seen this one yet. I know it's kind of a classic. It's Bing Crosby. I should see it. But every year we've done the Bells of St. Mary, and that's going to be Monday, December 9th at 3 p.m. This will be on our website. And if you're a client, you'll get an email about this. National Lampoon's Christmas Vacation, we've got tickets for as well. We're sponsoring that movie. I should say sponsoring, not hosting. But we sponsor these movies so that they can charge reasonable ticket prices. Sometimes they do them at no cost, but it's usually reasonable ticket prices, and to be able to bring these films to the community. So the Bells of St. Mary, National Lampoon's Christmas Vacation. That's also December 9th at 7:30. Elf for grown-ups. This is kind of fun. 21 and older. You have to be 21 and older, but that's Friday, December 13th. The activities begin at 7 o'clock. The movie starts at 8 o'clock. So what are the activities? In the hour leading up to the movie, guests will enjoy one complimentary drink, free popcorn, a trivia contest, and a costume contest. Elf-themed prizes will be given for trivia winners, and the best-dressed elf will win a special prize. Only elves 21 and older will be admitted. That should be fun. Maybe we should see if we can do a work event around that. I think that might be the same day. No, it's a week before our Christmas event. But then we have Home Alone. We're showing or sponsoring Home Alone Saturday, December 14th at 9 a.m. Family-friendly morning screening, great for all ages. We've got some office closures coming up this Friday. Our office is going to be closed. Everyone is going to be unavailable for Friday for our annual Worksgiving event. So we all come together, make delicious food, spend the day together as a social gathering for our team only. So the door will be at our office, but the door will be locked. No stopping by. We love you all, but this is a team event. Next week, of course, is Thanksgiving. We're going to be closed both Thursday, November 27th, and Friday, November 28th, so our team can spend time with their loved ones. Everybody's out of office will be on. Everybody, for clients, if you need something immediately, you can always reach me on my mobile phone. You all have my mobile phone. There will be no webinar next week. I want to wish you all a happy Thanksgiving. I want to thank you for your support, ongoing support. It's been 24 years that I've been in this industry. It's been 15 that it's been an independent firm, and we grow as a team. We grow with our great client family every year, and it's really exciting. I want to thank you for your support, your great feedback, help with the growth of our firm, this channel, our podcast, and helping us continue to grow and learn as professionals. Because every time that we bring on new challenges, whether it's somebody working through something, it helps us. It helps us grow as individuals, as professionals, and we appreciate that. I hope that was helpful today. I look forward to seeing you all back in a couple weeks, and I hope you have a great Thanksgiving. Take care.